but it is what it is. All right, everybody, welcome back to the Cashflow Chronicles. We are commandeering the Finance Junkies time slot. Chris alluded to me that they were going to be canceled today, so a little special episode. I get Chris on a Sunday night.
This is not stealing a time slot. This is just like, hey, I have some time, you have some time, and the 9 o'clock thing works. So
exactly. I apologize. I said it was going to start about 53 minutes from now. I got my time zones mixed up when I was creating the StreamYard. So otherwise, we're here, happy. Chris, I'm sorry. I wanted to apologize. I was literally about to hit buy premium version for StreamYard. So unfortunately, you're going to have to deal with the duck in the upper right-hand corner just for one last episode, and then we'll eventually get ourselves back up to a premium version, so we're not in the poorhouse anymore. But hopefully, as everyone's having a great weekend, they're well relaxed, and I'm ready to talk about stocks. Chris, you had a little bit of an agenda. I'm going to throw it over to you, and I'm just going to do some zeroing out of some account numbers so we can share our portfolio.
Yeah. So one of the things I just wanted to quickly point out that we've done exceptionally well the last month. So that's been good to see, of course, in the market. The only thing is, we might be heading into some choppy weather, going into January. Now, one of the things that's really concerning to me is just how far oil has actually dropped down. I don't know if you've been keeping track on the oil prices, but
it's my life, so a little bit,
yeah. Oil. So for the most part, oil's been like oil prices going down is a good thing for inflation. So that's a net positive. The problem is if it dips too low, it can have all sorts of secondary effects. And one of them, of course, is being that right now the U.S. production of oil has been steadily increasing for a while now. And let me actually just pull up that data.
Pretty astonishing.
Yeah. And I mean, to be fair, it's not that astonishing because the U.S. has always had this really great innovative streak behind it, especially in the oil and natural gas space. So if you look at this is the U.S.'s crude production, total production of crude.
I haven't seen it in a couple months. That's pretty crazy.
And this is just the United States. So, this is historical. So if you go back all the way to the 1970s, that was like a peak. And then we kind of started to die down a little bit into 2008. But then comes, of course, shale. And shale has just been rocketing up higher and higher. And you can actually see that now it's at an all-time high. So about 13,236,000 barrels per day. Now,
13
this is is it 13 million? Yeah, 13 million barrels per day of oil production in the United States, which is freaking nuts. What's good is that it gives us this ability to kind of control oil prices, because what happens is usually OPEC, being the cartel it is, they come out and say, hey, oil should be at this price, and then based on their saying, we kind of just have to live with the price. But being that the U.S. is not part of OPEC, we're actually, dictating oil price. So we can actually make oil prices go higher and lower because now we've effectively taken control over such a large block of it. So one of the things that we saw this week was Putin meeting with the Prince of Saudi Arabia, who's their de facto leader at this point, Mohammed bin Salman, MBS. And they seem real chummy. OPEC and Russia, they're together. They're called OPEC Plus. They've basically been on this cutting spree of helping support prices. Their long-term vision is that there has to be some level of price stability that's built into the oil markets to basically keep production at a level that's not oversupplied, but not undersupplied. And on the other hand, the U.S. being kind of like a free market system, we're like pump, baby, let's go. But even we face some challenges because the oil that we produce versus the oil that they produce is two different break even. So the Saudis, they basically take a straw, put it into the ground, boom, they get oil. So their marginal cost of production is super cheap. For us, we actually have to like drill and then puncture the rocks underneath, and then put some solvents in there, and then extract the oil, and then extract the oil out of the solvents. So there's like a whole lot of processing that needs to be done for our oil to come out. The thing is, though, the break evens when it comes to us is a lot higher. So what happens is the Saudi Arabia, they can pump oil at $50 a barrel and still be profitable. For us in the US, at $50, there's a lot of projects that would go out of business, you know, and so that is actually a problem. Now, where does the opportunity for us lie? In that, I think that the $70 price of oil right now on WTI is actually a floor. You know, I don't think it can go lower than that by a whole lot. So that means that a lot of the companies that, especially the super majors who have these giant reserves in the Permian, they're going to be able to, you know, make some healthy profits at $70. But anything lower than that, and they're going to start to really have problems. So even they are probably looking to cut back. So you have kind of have the Saudis, the Russians, and even now U.S. producers likely to like not produce as much going forward because they need the price of oil to stay above 70. And then the U.S. government at the same time, I don't know if you've been tracking this, but they've been refilling the SPR. So, you know, we've been net users of the Strategic Petroleum Reserve for the last, you know, 2 years to control oil prices, to make sure that inflation doesn't go too high. But now we're starting to refill it. So actually, Department of Energy started to buy up oil and refilling, and the only thing limiting them right now is the capacity to refill. And that's another thing that acts like almost like a sponge to oil demand. So now what's happening is now you have consumer demand for oil, but then you also have demand from the federal government looking to refill the Strategic Petroleum Reserve at $70 a barrel, $75 a barrel. So that puts a floor in oil prices. So, I mean, I'll stop there. I'll let you comment.
I think you well said for a lot of that. I think the one thing that I might note is while it might be cheap for Saudi and a lot of these other companies in say the Middle East to be lower break-even costs, you have to recognize that a lot of their economies and governments unfortunately run off of the profits of that. So while they might be breaking even from a company standpoint and being able to get it out of the ground, they're more of welfare states for a lot of these cases. And so generally speaking, the companies themselves, I'm not going to name any, but the companies themselves will do really well. The economies themselves will have a different break-even point because obviously that's not the company, right? The company feeds the profits to the government, and then the government is able to then give those profits out to the people in terms of welfare state to help pay for education, healthcare, just daily costs of living, groceries, and stuff of the like. So that is why OPEC tries to keep oil at about this price, because they recognize that underneath of that, they start to having to put a collar on giving out, I guess, surplus to a lot of their people. And obviously that's when people, unfortunately, have to pull back and everything the like. So the same sort of thing happened in the 2014, 2015 timeframe. And the same thing happened, I guess, in 2018, 2019, pre-pandemic, when we were at about 12 and a half, 13 million barrels a day in the US as well. When we became the number one oil producer in the world again, being the United States, meaning, a lot of people were having to cut because the other countries are in OPEC and the United States is not. And so in that respect, that's kind of coming out at 13, going on 13 and a half million a day right now, is just the balance of the profits from companies like Oxy, companies like Chevron, companies like Exxon that are putting a lot of money into great fields like the Permian, which is up around 7 million barrels of oil a day production alone. The Gulf of Mexico, which is about 2.5 million barrels a day. So that respect, you're close to 10 million barrels just from those two kind of basins alone. And then you couple that with maybe the shelf production in the Gulf of Mexico, the Eagle Ford, a lot of these other areas, the Bakken's at about 1 million barrels a day. So huge basins that are able to provide, 13 odd million barrels a day, huge natural resources. And to be very frank, we haven't even discovered or exploited a lot of those opportunities in the Four Corners part of the United States as well. There's a lot of opportunity still remaining there. But also places like Guyana, where is kind of outside of the OPEC remit, that are just coming online. They're going to be getting close to 1 million barrels a day themselves. But that being said, all of that, the oil price is very, very delicate because it's all based off of supply and demand. And so when you think about it, a lot of times what we're talking about is 1 million barrels here, 1 million barrels there. And what I mean by that is generally speaking, the demand is about 100 to 102 million barrels of oil a day. And that's pretty much where we were at pre-pandemic. And now we're back basically at that or above that now. After a little bit of 3-year hiatus, everyone's kind of getting back to normal, China opening back up over the past 12 months, etc. So everybody thinking that oil was going to zero, during the pandemic, unfortunately, you're wrong. Yes, it did take a 10, 20 million barrel a day hit down to 80 million barrels or so a day. But now we're back up to over 100 million barrels of oil a day. And I don't think that demand is going anywhere. In fact, I think it's going to continue to expand at 1% to 2% per annum for the next, I'd say, 8 to 10 years. And then I think in the early 2030s, we'll start to see efficiencies in how we use that, getting more extraction out of energy, what have you. But that being said, when you look at a supply demand curve for oil, it's really in a 4 million barrel band, 2 million barrels above demand, 2 million barrels below demand. And that is what really drives this extremely volatile price in oil that you see sometimes. And even still, sometimes it doesn't necessarily have to be the fact that supply gets impacted, right? In terms of how much oil people are producing, sometimes it's supply chain oriented, like what we saw what happened in Ukraine last year. It wasn't necessarily that people were stopping producing oil. It was just the normal influx of oil.
I think
changed.
your internet.
Yeah.
I think your internet may be a little bit weak today.
Oh, is
Matt.
it? Damn. Yeah. But anyway, with that, I'll hand it back to Chris. I went on a little bit of a hiatus.
Yeah. So Heinz actually is asking a really good question. Are we selling U.S. produced oil to supply Europe because they no longer have Russian oil? Yes. I mean, they do still buy Russian oil. Don't get me wrong. They're just less dependent on it these days than in the past. So right now, the U.S. has actually been producing a lot more. I'll actually show you the ship data.
Because if you really want to, which we'll talk about.
Yeah. Yeah. If you want to ever see how the U.S. transports it, it's, you know what? You talk about the natural gas demand, and I'll pull up the chart for the U.S. shipping to that.
So with respect to natural gas demand, the big piece was, and this is kind of getting into geopolitics a little bit, and I don't mean to, it's just the reality of the fact. So I'm not taking any sides or anything like that. But generally speaking, Poland and the rest of Europe was mostly dependent on Russia for their natural gas supply, which a lot of people might have heard in the news about Nord Stream and Nord Stream 2 being bombed, associated with what was kind of going on with Ukraine. And with that, you kind of had that big disruption in natural gas prices. And Chris, just remind me, because it's kind of light whenever you're ready to share something. So you saw natural gas prices go from the order of, let's just say, the middle teens in terms of pricing per MCF to in the hundreds almost for some countries for a month or two back last year, just based on the fact that the supply chain had been kind of cut. And a lot of times people hadn't really been focusing on importing LNG from a lot of places. Yes, there were those contracts set up, but when you had Germany and Poland being so reliant on Nord Stream and getting that gas from Russia, no longer can they because of all these sanctions. The demand obviously was not being met by the supply because they weren't able to necessarily fulfill all the contracts that were previously negotiated. And obviously you had all these sanctions going on with Russia. So how are you supposed to do transactions if you're not able to use the ruble, etc.? So that's when a lot of natural gas prices in the United States started to go up in 2022 and 2021 because everyone was kind of was it last year, 2022? Because everyone was starting to take the local supply gas, which is very cheap, as you can see, $2.50 now, but around $3 Henry Hub, and take that and immediately push it over to to Europe, and get anywhere north of, say, $30, $40, and in some cases up to $100 per million cubic feet. So they're making a huge killing and margin off of that, which is year. That's why they were so inflated to an extent. Their profits were massive. And a lot of them had to do with the fact that they were able to sell these contracts at exorbitant prices just to be able to keep up with demand. And so you saw the same thing with oil pricing. Even though oil was being made, Russia then had to switch who they were selling it to. So they started selling it to China. They started selling it to India at cheaper prices than what they used to, which was selling it to Europe. So that sort of is what caused the oil price to spike up briefly throughout the middle of the year last year, is because you had to rearrange the supply chains. So previously we were probably sending or not getting as much oil from Russia, but probably some in Europe as well. And then you had to start resupplying them, whether that was coming from the United States, whether it was coming from Canada. So all that sort of took an impact, because we still import about 3 million barrels a day, us meaning the United States, from Canada, because that's just how some of our refineries up in the Chicago area are kind of situated, right? To be able to handle some of those heavier crudes that come from Canada. And that's why some people import from South America United States oil, because it's lighter. Some of our refineries down south here in Texas are able to handle some of the crudes that come from Venezuela, because they're heavier, higher sulfur content. So all these people, depending on what you get, you could be looking at lighter fluids. I'm sure when you look at propane's kind of a liquid gas, right? If you think about it, it's what you use
it's an NGL.
Yeah, it's an NGL that you can kind of use, but it's not the same thing that you put in your car, right? So you put, probably butane all the way to heptane, all the way C4 to C7 into your car. C4 being butane, C7 being heptane in your car. And that also can be a liquid, but you also see the vapors coming out. So some of that could just be the fact that it's depressurized, what have you. But all these things can be derived from oil, right? You can get propane from oil. You can get methane from oil. You can get butane from oil. So all these different products. So depending on what people's needs are, plastics, what have you, they'll need different types of oils. So that's why you have all this international trade going on. I know I didn't really have a very succinct way to kind of describe what I was talking about, but hopefully it gives you a little bit of a background and context.
So here you can see the U.S.'s production has gone from 7.7 million barrels in 2008 to now almost 13.2. But here's the thing. If you look at how much the U.S. actually is exporting, it's exporting significant amounts of oil. Right now it's doing about 9.58 million barrels of oil per day, and it's importing negative 1.26 million barrels. So it just goes to show that all that production is just getting bought up all over the globe. And now with the Russians being what they are, the US is slowly replacing them, right? So refineries in Europe that usually may have been used to Russian oil now are taking crudes from us and using that to basically refine their petroleum needs. Same thing with India, as China is kind of slowing down a little bit with their demand picture. Just because of GDP and economic contraction, you're seeing other companies kind of make up the difference and buying up a lot more oil. India has traditionally been a big buyer of not so much Russian, but mostly Iranian and Middle Eastern oil. So even India is starting to kind of import a little bit more too. So the world of oil is very challenging sometimes, but then there's also times where you can actually make some good money. One of the companies that I really like, of course, is ExxonMobil, because of just how widespread of infrastructure that they have, the contracts that they have. ExxonMobil is known as a super major. So super majors typically have all sorts of advantages over their smaller competitors. One, of course, is that they just have so much more capital coming into their ecosystem. So even though right now you can see this and you're like, oh my God, their net income is down, majority of that net income decrease is coming from the price of oil fluctuating. But if the price of oil starts to rise, sorry, I'm getting a little sick. Oh no, I had some roasted nuts. I hope I'm not allergic to something that was in there. Whatever.
Hope not, my guy.
So yeah. So if you look at their cash flows, though, you can see that they've been growing their cash flows significantly. And last quarter, they had almost operating cash flows of almost 16 billion, which then they took some of it for financing and everything else. But you can see here that a lot of that went to repurchasing capital stock. And they're actually due to do almost 20 billion of capital repurchases, which is stock buybacks in the next year. So, so hold on one second. Stock buyback program. So at these undervalued prices of their stock, that giant earnings boost that they're going to have post their closure with the Pioneer deal, they're going to have about $20 billion of additional cash flow that they're going to be generating to basically buy back more and more shares. So, with Exxon being at a depressed stock price right now, it's like I said, it's not a bad idea to be in it, especially if oil starts to rise higher. So if you look here, in July, when oil prices were down like about $70 a barrel, which is what they are today, when oil rose to about $90 a barrel, you can see that Exxon's price kind of jumped up to about 120. So we could see a repeat of that, if the Saudis go ahead and, start their production cuts again, the Russians join them, and then we're also dealing with a lot of geopolitical issues with Guyana and Venezuela kind of invading, well, possibly invading, and U.S. sanctions might get put back on Iran again thanks to this whole Israeli conflict. So that just takes away some major producers of oil. So, like I said, that could be something to just keep an eye on, and it could end up, helping ride a nice wave higher. On top of it, Exxon pays a pretty healthy dividend, about 4.25% or 4.5% dividend.
I don't know if it's that high, but it could be depending on where
Yeah,
they're
it
at.
is.
I know
It
they were
is.
paying like 80 something cents a quarter.
Let me see what their dividend is
So you might be
right
on.
now. 3.82, so about four,
Okay.
about a 4. Yeah.
Yeah, but I do want to give some color onto that. So, I mean, this gives an idea as to how to value a company, right? So, 2022, what Chris was kind of showing there was a lot of different things like net profit margin going down year over year and revenue going down year over year. You have to think last year in the June-July timeframe, prices were up in the $120 a barrel range, and now they've come down, close to 33% from that point. So obviously, a lot of the revenues and net incomes are going to be impacted. So that's one of the things you have to look at for some of these cyclical producers, or not cyclical producers, but cyclic industries, specifically like oil or even coal or other natural resource companies like miners like BHP or gold miners or anything like that. You have to recognize that they're very much dependent on what they sell, which is obviously oil and gas in this respect. So that doesn't mean that they're not going to make money. And that's why I think Chris is talking specifically about, well, they've kind of been depressed over the past year or so. And now we're getting to a place where $70 might be a good place to start to acquire an opportunistic position if you think it's going to go back up to the 90s or even $100 range. It could be a place where they're starting to get beaten down. I'm more on the line of, I think that there's a couple more quarters to go for things to truly play out. But Chris thinks that there's an opportunity. I see an opportunity as well. I mean, there's a lot of geopolitical issues arising right now. The strategic petroleum reserves are going to be filled back up. So I get it. I think $70 isn't a bad price. I think it's a fair price for everybody. I think the problem might be is that people are getting a little bit greedy. And unfortunately, that might lead to probably is good for the supply and demand curve personally. But anyway, that's just some food for thought. But I want to give some color to Exxon, because Exxon, as Chris alluded to, is buying Pioneer. That's a huge Permian deal that's being, and I think they're like 500,000 barrels a day or something like that. So a huge deal with respect to just the production coming out of the Permian, which that'll make obviously Exxon be the premier producer out of the Permian. But also they have these Guyanese FPSOs that are coming out there. Just in the Guyana waters, they've discovered 13 billion barrels of recoverable resources, of which 45% of those resources are allocated to Exxon because they're partners with CNOOC, which is a Chinese oil producer, and also Hess, which is probably one of the main reasons why Chevron went after buying Hess, because this has been a huge cash flow machine for Exxon. They have a huge success rate with respect to their wildcatting in the above 85% range. Every time they drill, it seems like they find something, whether it's an appraisal or whatever. So at this point, they have 3 boats online, the latest of which is producing 200-some thousand barrels a day. Of course, it'll take some time to get up to that maximum, but they're producing about 500,000 barrels of oil a day just since 2015. They've been able to produce this, and they just started putting boats out there over the past, say, 3 years or so. They're in a line of sight to, and this is important, a line of sight to another 2 for now that have made a final investment decision to put into waters, but a line of sight to 7 or 8 boats total, just based off the resources they've discovered. And so that being said, I want to take a step back to what the John Hess, who was the previous CEO, maybe still the current acting CEO of Hess right now, said just a few quarters ago, which was even at $60 to $65 a barrel oil, maybe it was closer to 70. I'm not exactly sure on the exact quote, but it wasn't an exorbitant amount. It wasn't like $100 or $120 a barrel. It was something around this realm. Hess alone was making $1 billion per boat in free cash flow. So if you think about it, Hess is a minority position in all these projects going on in Guyana. They have 3 boats, so that's $3 billion in cash flow from them. Plus, they have line of sight to 7 total boats in Guyana. So that's about $7 billion of cash flow assumed for Hess in free cash, right? That's after expenditures. That's after continuing to explore. That's all that. And then you keep in mind that Hess only has 30 or 35%. Exxon has 45%. So when you start to think about how much cash flow some of these projects are generating and how good of cash, you're talking pretty good numbers. And then if you look at something like a Shell alone in 2022 made over $60 billion in cash flow from operations, which is on the equivalent of what we're talking about when we talk about the Googles and the Metas of the world. And so when you think about it in that respect, you're like, well, why isn't Shell a $1 trillion company, right? Instead, they're sitting here at a $250 billion market cap. And it's because of the cyclical nature of what's going on in some of these sectors, right? So tomorrow, or just like what we've seen, Shell's probably only going to make $40 to $45 billion in cash flow from operations this year. 15 billion of that just evaporated just based off of oil price alone. It may be even more because natural gas prices are even down more so. So you have to think about, especially when you invest in something like oil and gas, the contracts and what they're getting evaluated at. And so maybe it's a good transition piece to talk about maybe some of the LNG things that we're thinking about purchasing, Chris.
Yeah. So there's a couple of ways that you can play oil and natural gas that removes a lot of that cyclicality out of the equation. And so the valuation, if you can remove the cyclicality out, it's actually very profitable, right? So there's 2 ways to really do it. One is to buy midstream assets. So these are like the pipes that go directly to the fields, to the processing, or to the delivery areas. So one of them, of course, and this is the one that I would probably look at more than anything, we haven't added to our portfolio. And I'll tell you why I don't like investing sometimes in midstreams, is because you have to deal with the damn K1. So, when you're investing midstream assets, a lot of them come under something called an MLP. MLPs are master limited partnerships. So what happens is you're technically buying shares in the partnership. So you're getting partnership units. So which means that the taxes are not paid by the corporation. They're paid by you as a partner, right? So all of it filters down to you. So you get issued something called a K1, which is, to most people, it's a hassle to deal with. I don't know, Matt, have you ever dealt with K1 issues? Because I know you're definitely an oil and natural gas and dividend guy, so you definitely had the K1s.
Yeah, and I have personal K1s too, which is not fun.
Yeah, so dealing with K1s kind of sucks a little bit. So, this is why This is why one of the reasons why people stay away from MLPs. But what's good is that there are certain partnerships, not MLPs specifically, but there are certain partnerships out there that do get treated as ordinary income. They don't have something called UBIT, so that you can actually take advantage of the taxes. So we're not going to speak too much about that, because I think if we talk about it too much, and I don't want people who are not familiar with the accounting practices and how it affects their taxes to go into these things. But yeah, so just that's one way to do it. The other way is to buy companies that actually do servicing, like they actually do, like Schlumberger, right? Schlumberger is a big one that does oil and natural gas field. What is that thing called? Basically, they're service providers. They provide all sorts of testing and everything else. But that's another way. I am more on the side of, hey, commodity prices are low, buy the underlying stock, let the stock go up, sell it when the commodity prices are high, and just sit back and relax a little bit, and I think that's the play for me with regards to Exxon. You can also buy bonds on some of these, which is another helpful way to make some money too. Because what happens is sometimes bonds will get distressed because the underlying commodity ends up being at a low price. Everyone's like, oh my God, the bonds are trading at super low prices. And so if you get into the right at the right time, what happens is the commodity prices that recover, and then your bonds end up becoming safer and they recover too, but they recover more meaningfully. And the entire time that the company's still existing, you're making money on those interest payments. So if you can buy a bond on an energy company that's doing well at a cheap price, you can make some money. You can also lose a lot of money that way too. I've had personal experiences.
But I think it's prudent. I mean, these cyclical stocks, right? I think a lot of times people get. This is part of the reason why I'm not jumping full port in. Based off of kind of what Chris is talking about. I don't really like to deal with these unless the price is extremely cheap. Yes, I have my Shell shares, but I like to jump in. Like during the pandemic is something when I jumped into oil and gas really, really heavy. And you could see as to why, because Exxon, I started accumulating it in the late 2019 time frame. I was starting to buy it in the low 60s because it's starting to get pretty cheap. But then I was buying hand over fist, during the pandemic time frame when it was trading in the 30 to low 30s range. And I was buying it probably all the way up to the mid 50s. But I bought at some point, I forget how much I was up to, but it was a significant portion where it was like, okay, I've made my money, I'm going to take it and run. I think I sold it a little early. I think I sold it at $90. I didn't think it was going to run, but they've obviously made some really good choices. Obviously, they bought out Pioneer. They've done a lot of other things made more discoveries in Guyana. Profits that were sitting there when you had a cost basis, I forget how many shares it was, but going a cost basis of $40 to where it was trading at was over 100%. So it just didn't make sense for me to continue to hold on to those prices. So I think I sold half of it, moved it to Shell, because I think Shell's undervalued comparatively to Exxon and comparatively to Chevron, and I moved the rest to the SPY. But yeah, these are things that you really have to look out for. You don't want to be buying them when oil prices are high, right? When prices are doing well, their earnings are up year over year. Like that, you have to think these are cyclical nature sort of stocks. And it could very well be that oil price goes to $200 for a short, brief period of time because there's some geopolitical issue or something like that. But generally speaking, you want to buy when everyone thinks it's the oil prices are terrible, all oil companies are going to zero. That's when blood is in the streets, that's when you want to buy. To be very honest, one of the stocks that we're actually going to talk about in the personal portfolio that we picked up, I remember people reaching out to me when it was $12 or $13. And I was saying, I don't know, man, it's scary. I don't know if I would do it. And to be very honest with you, it was scary. And the company that we're talking about actually had preferred shares out to Warren Buffett. And they were in such a dire cash flow position that they actually stopped paying the cash back on the preferred shares, and they were giving him more shares. They said, you know what, like we'll give you more shares of the company instead of having to pay you out because we didn't have the cash at the moment. They weren't able to get the cash flow. And they had just bought Anadarko and they were buying a bunch of great companies, which now it seems like, the smartest move, but they were probably 50-50 in going bankrupt. And had the oil price after the pandemic not recovered, these guys were probably 6 months from probably calling it quits. But the oil price recovered and they were able to start paying down some of that debt from buying a lot of the Anadarko assets, which I work on some of those actually in partnership with them. But it's an interesting kind of take. These things can be fly by night. Transocean has gone about almost bankrupt several times, and it's just unfortunate because Seadrill has gone bankrupt. There's companies in here that get eliminated, and a lot of people that were in the Gulf of Mexico that we used to be competitors with, just unfortunately, when I started in 2013, are just no longer there because they've either gotten bought out because they were basically going bankrupt or they did go bankrupt. And so you kind of had to play your cards right and about where these companies are going with respect to how financially savvy are they? Do they have the right, management in place? Because if you have the right management in place, you can work yourself out of anything. But sometimes you think a lot of these companies, which is not really the case anymore, but back in the early 2000s or 2010s, they were coming off of, in the early 2000s, let's just say $20 a barrel oil, all the way up to 2008, when it was over $100 a barrel for oil, right? So easy to continue to just drill, baby, drill when price goes from 20 to 100. But the problem is when you have so much demand. Chris was talking a little bit about some of the suppliers and contractors that people hire to get oil and gas projects done. When you have so much demand and everyone's making so much margin, over time that margin gets squeezed. So if we sit here at $70 for several years, eventually there's going to be some companies that stop making money because everyone's going to be able to continue to drill, make money at $70 a barrel. So if that's the case, eventually it's going to be, let's just say you're making $1 billion today. Over time, you're only going to be making $500 million. And then you're only going to be making $250 billion because so many people are going to continue to charge for their prices. And then that's part of the beauty of oil and gas, is that there's inflation, not only for what's going on in the macroeconomic economy, but I'm sure that you've seen in specific sectors, like Chris is kind of talking about, when we talk about CPI and all that. Contract services have inflation, steel prices have inflation. So you have to deal with all these things when you're running an international business, like what we're talking about with Exxon. And that's when you start to see, the beauty of what's really happening behind the scenes with some of these companies. But anyway, enough of a tangent.
Okay, let's go into one company that had some recent news that me and Matt, at least to a degree, we follow and could present a opportunity, let's say, a very high risk opportunity, but the rewards can also be very high as well. So we can talk about that and possibly see if there's an opportunity here. And maybe Matt, me and you can, and you know which one I'm talking about, right?
Yeah.
All right.
You want me to share it, or what?
Yeah. Go ahead, share it.
Share the Robinhood, or?
Yeah, go for it. Let's do both of the ones that we have, which is okay. So this company, Tellurian is a natural gas export company that has no real export capabilities yet. Tellurian was founded by Sharif Suki after he was kicked out of Cheniere Energy, which is ticker symbol LNG, and LNG makes a crap ton of money because they just do really well. And basically, they have been kicked to the curb. And he because of his name, was able to raise a lot of money at certain points during Tellurian's existence, and been able to basically keep the project going. So One of the things with Tellurian that did not pan out very well is that Tellurian chose to basically try to disrupt the business model of how natural gas and natural gas liquids are exported. But so basically right now, in order for you to get these to get the money required to build these export terminals, because they are very expensive. I'm talking about 10 to 20 billion dollars. That's the cost of an export terminal. So they're not cheap by any means. In order to get that capital, usually what happens is that money usually comes from two sources. One, from a lot of debt, which Tellurian can't really access because they have no revenues. Like, no one's going to lend you money into a black hole, right? So that's number one. The other way is by selling equity to shareholders. And so this way, shareholders would basically benefit from the profits in the future. And of course, the third way is by selling equity in the sales of future deliveries. So basically, what you would do is you would set up a system whereby you have fixed contracts in the future with certain entities that say, hey, we will buy natural gas from you for these prices, and we will basically we'll be able to basically make money, and you get to act as the toll bridge, and you collect a certain portion of the money, but essentially you're just a middleman. You're not really like going to benefit from price rises and dips as much. So those contracts are usually 20 years out. Sharif Suki said, no, we don't want to do 20-year, 30-year contracts. We want to do short-term contracts because we want to benefit from the rise of natural gas prices just as much as you guys are. And so a lot of these guys said, hey, listen, Sharif Suki, go kick rocks. And basically they all bailed on him. And he ran out of money. He ran out of cash, and then eventually the company kind of just said, you know what? You're too much of a liability. And so they kicked him out. So he's been kicked out twice now. But essentially, there is some value in the company. There's two parts of this company that could provide a lot of value. Number one is that they do have some upstream assets that they were able to buy not too long ago in the Haynesville area. So basically that area, they have upstream assets, which means that they actually have acreage where they can drill and get natural gas and natural gas liquids out of that shale formation. The original plan was that natural gas production would then be fed through pipeline to Lake Charles, which is where the facility is called Driftwood, and that natural gas would then be put on boats and then sent to overseas, and you would make a ton of money on the spread. Because if you can buy something or produce it for, let's say, $1, $2, and then sell it for $14, $15, that is a lot of margin that you can make. The problem is, of course, you need to have that export facility. Otherwise, you can't really do anything with it, right? So I'll stop there, and maybe Matt can go on a little.
Yeah, I think the thought process is, Haynesville, there's a lot of dry gas that you can produce very cheaply. And so it's not hugely profitable if you're only putting it into the US market. And so the thought process if you're able to produce this Haynesville gas basically at cost and be able to send it through your own pipelines directly to the Japan market, the Dutch market, you're going to be making anywhere between, let's just say, $8 to $13 of premium on that versus what you're going to be able to do by selling it to the US market. And so that's the thought process that these guys probably had. And they were saying, you know what, we're not going to sell ourselves short. We want to be the ones that are providing out all this upside. And unfortunately, it just is either taking too long or just not coming to fruition. They just don't have the capital to kind of see it through. So interesting thought with this one. But there's another one which I dabbled in smallly. I don't even know if we got a whole share of it because Chris told me only to buy what we get in dividends for this particular company. We got $1.26 in dividends last month from TLT, which we have to talk about as well in the portfolio. and we bought NEXT, which is a company that is actually, if you guys are familiar with SpaceX, these guys are building a LNG terminal, 17.6 MTPA LNG terminal, just around the corner from SpaceX's Boca Chica facility, just all across the border from Mexico. And so these guys are building with a Rio Grande LNG. So they actually are building the first 3 trains for this. And the big thing is nobody's really excited about the first 3 trains. It's not going to be very profitable. It'll make money, right? And maybe, I guess, as Chris is concerned, because sometimes these things go over budget and get delayed, which I understand. I work in oil and gas, and I get that, and I see that happening all the time. But the 4th LNG and the 5th LNG terminal for this one is going to be where the big profits kind of come in. And so the hope is that they're able to survive long enough to get to that point without any further farm downs, without any further kind of impact to scheduling or anything like that. But before I hand it back to Chris, because I wasn't sure if he was done talking about Tellurian, I have 125 people at this point in the chat. So really love the first time we're here on a Sunday, getting all this love. If you haven't subscribed to us, recognize this isn't the Finance Junkie channel. This is my channel where we host Cashflow Chronicles. We're normally live Tuesday through Thursdays, but we just saw the chance. Chris had some extra time, so we saw the opportunity to come on a Sunday and talk to you guys briefly. We have a lot of stuff to talk to you guys about this week. Chris and I were chatting about ETFs and personal portfolio changes and all that stuff. So we'd love to talk to you guys every day if we could. So be sure to like and subscribe if you can. And I'm going to hand it back to Chris to see if you wanted to talk any more about Tellurian or if he wants to chime in about next.
Well, let's do next, and then we can do Tellurian. So next decade, the good thing about them is that they actually have the money. So they're actually in the process of building now. They've already got FERC approval, which is the first step usually, which is the federal government has to give you approval to say, yes, we will allow you to build it. And last thing that you need is something called an FID, which is final investment decision, which means that you have all the money lined up, ready to go, and your builder is ready to put groundwork in and get the process started. The problem is even construction is going to take a while before it really comes online. And then you're going to have to get those cash flows. So right now, next decade is very, 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 let me repeat that, very early in making any money. So if you do buy next decade, don't expect this company to skyrocket tomorrow morning. Hell, it may not even skyrocket for the next 5 years, so don't think that this is something that's a small investment. So one of the decisions that me and Matt made when it came to our portfolio was, hey, let's just keep adding small amounts of it over time. So this is a coffee stock. What I mean by coffee stock is instead of spending your money on a piece of, on a coffee, why not just buy a share of this company? Nothing that's going to hurt you, but nothing that's going to be bad. And if everything works out correctly, dude, this is maybe a 20x, based on all the demand that could possibly generate. So take a look at that.
Yeah, I mean,
Matt, your internet's lagging bad.
Is it bad? Damn, man. I don't know. I got to call Comcast. I don't know what the hell this shit is.
Yo, call Verizon. Get yourself one of those.
I did, man. They said they weren't ready for 5G in my area. I was pretty upset about it. Yeah, this is the only person I could. It's a new development. So few people even. Maybe they are available. They just didn't realize it or wasn't set up in their system yet. But anyway, NEXT, their thought process is, with 4 or 5 trains, which there is possibility to have 6 and 7 trains there. 6 for sure. 7th one might be a stretch. But the 4th and 5th trains, if they're online, the thought process is they're going to have $1 billion in distributable cash flow for people to get dividends and buybacks or what have you. So if that's the case, you're basically buying the company today at $1 billion for a future $1 billion per annum distributable cash flow. Now, if you throw a multiple on that, let's just say it's a 10x or 15x per, for the distributable cash flow, then you're talking about a 10 or 15x from where we are today. But like Chris said, there's going to be a lot of caveats associated with that, right? I mean, we're talking about the first 3 trains, which was the slide I'm talking about today. Those are the ones that have been sanctioned. Those are the shovels that are in the ground being developed right now. So you probably won't see first gas until mid 27, if not 2029, just based off of how these things go. And so, the same thing happened with Cheniere when they were bringing on Sabine Pass. It was supposed to be this year, then it was that year, and now they're printing money, and you don't have to worry about Cheniere anymore. But the thought process was you're always just sitting there playing this waiting game of you're just spending and spending and spending, and you're not getting anything at that point. But the real money is going to be when they actually get these things flowing, and they're able to sustain their cash flow and pay back, debt and everything of the like. Because this is a $25 billion project, right? That Total is paying into, this company is paying into, a lot of other Middle Eastern companies that have bought into it are paying into. And so the nice thing about this, before I go down the rabbit hole, is this part of it, which is, sorry to give everyone flashbacks, all the different flashes. This is the piece that shows that this thing is going to work out, because if they build it, these guys have already promised to be able to offtake all the natural gas that this LNG terminal and facility is willing to give off. So you have Shell, Total, Exxon, all these different companies that are willing to work on trains 1 through 3 to distribute the gas to their clients internationally. So these guys have come up with hey, we're going to buy it off of Henry Hub prices. We'll give you boom. We're going to distribute it on your behalf, and you guys make a decent cash flow from that. So it's pretty nice to be able to see that trains 1 through 3, they're the 17 MTPA that's going to be out there. 92% of that is contracted. So you basically have guaranteed that if this thing is built, that you're not going to be wondering who's going to be your customers. You're not wondering, if you're going to have the money coming in. You have reputable people that are going to help you out.
Yep. And this is the part that Tellurian could not do. They couldn't get enough people to sign up for all of this. And basically because of that, the project kind of just died on the vine. But that is where the opportunity is, Matt. So if you go to Tellurian stock price, which I do not recommend anyone buy because the stock is actually, in my opinion, worthless at this point, they do have one other asset class that may be worth buying. So let's look at TELZ. TELZ is a bond. Let's see if it actually shows up on here, because Robinhood might not even have it. That's how actually Robinhood should have it. Go to TELZ. Let's see. All right, so they don't have it. I'm surprised that they don't have it, actually. Hold on. Let me see. Let me look at mine. TELZ. Tellurian.
Work. Putting crystal work.
Nope, they don't have it. Okay, so Robinhood does not have it.
My guy, you thought I was lying? Straight lying through my teeth on street?
I didn't say lying. Maybe I was looking at something different.
No.
All right, so instead, we're going to look at this right here. This is
Zocold says it's on Fidelity for sure.
It is on Fidelity. Fidelity has stuff. That's one of the reasons why I have a Fidelity account. So TELZ, what is TELZ? TELZ is a baby bond where basically you have a bond offering that's out there, but then also it's linked to a equity. So basically TELZ is an equity that's linked to the underlying bonds. Now the liquidation preference for those are $25. It's per share. That means that imagine right now you're paying a bond. The bond is worth $25. Tellurian right now pays you 8.25% on that bond. It matures in 2028, right? So you would be collecting $8.25 on a $25 face value of that bond. Now, the thing is that bond right now is only trading at $9.67 after the news that Sharif Suki has been booted out. it kind of gained almost 10% on the day, and it looks like it's almost at like $10 now. You can see here that after this this issue with the FID not being cleared, they really took a big hit. The thing is, though, because of the underlying assets and the importance of all the investments that Tellurian's already made, these bonds sit at a priority to the equity. Now, most bonds, when they're issued, they have something called a change of control provision in there. What that means is that if there is a material change in the company that issued the bonds become due automatically, like right away. So now whoever is the buyer of Tellurian, like let's say Tellurian tomorrow says, hey, listen, we're in a weak position, and someone from Lake Charles wants to, like one of the other majors wants to come and just buy the company out, they would have to basically pay these bondholders right away. Now, the key is if you can buy something for $10 and someone pays you $25 like within 6 months, I'll take it. Why not? Right. Yeah. And let's say Tellurian ends up getting a partner. Let's say right now with Sharif Suki gone, which was the main hurdle. If he's gone, that means that, hey, maybe the company would be open to do these 20-year deals again, which means that these bonds would end up becoming more valuable again. And then on top of it, Tellurian actually has upstream assets that are unencumbered, as far as I know, because I didn't have a chance to look at their debt structure completely. But for the most part, these guys do have worthwhile assets. So this is not something that I would say is like a great investment, but this is a quick speculation play, where I think we should buy maybe like a couple of $100 worth of it at just
lucky you, Chris. We have $337.
So we throw a couple of $100 at it. If let's say Tellurian survives, screw it. We're making like a 16, 17, no, not even 16. What would be the yield? What would be the yield on this thing?
Times about 2.5%, right?
Yeah, it would be almost
times,
2.5 times. That would
2.25 times 2.5, 20%.
We'd be making a 20% fixed return per year. And that's if Tellurian survives, okay? If they just survive, we'll be making that as income. On top of it, if they get bought out, we end up making 3 times that money. Well, not 3 times, like 2.5 times that money right away. So we're getting, $25 liquidation preference. So this is a very interesting high risk play, because they could just as well go into bankruptcy. And if they do go into bankruptcy, the equity would get wiped out completely. But the bond still might have some value, in which case then, you'd have to go through the bankruptcy process, which is never fun. But for the most part, as an investor, you really don't have to do much. So I say this is not a bad investment to make. It's a gamble, but it's an educated gamble. And I just want to show you guys something really quickly on how far Tellurian's actually come so far with regards to their Driftwood project, and why there could be some value.
I have no idea. I haven't done any work with it.
Take a look. This was in their last presentation. Bechtel's a big
yeah, Bechtel is making the Rio Grande project within NXT.
Yeah, so you can see here that they already have the land leased out. They've already got construction going on in the area. They've got all the permitting, the approvals. The only thing they don't have is the money to go on with the construction, which, by the way, is a problem, but it's not as big of a problem as people think. More importantly, though, is this. So you see here, Bechtel's already started doing all the groundwork. They already cleared everything out. Like I said, the long-term leases are there. The approvals are there. So this process alone takes about 5 to 10 years. Mm-hmm. Usually first you have to do environmental studies. You have to make sure everything is good. You have to build all the roads that are connecting these ports. You have to get approvals from God knows how many agencies.
Where's the Okay, there's the offloading. So the boat's actually going to come in, and
that's what I was going to show you.
For next decade, it's very obvious, but so it's a little channel.
Yeah, so this is actually kind of important. If you look at the presentation, hold on 1 second. Let me actually bring this big one up. Show. Sorry, share. Cancel. No, I don't want this.
I'll put in our buy order for tomorrow if I can find it.
Hold on. Lake Charles. So there are multiple LNG facilities that are under construction in that area. And so I think one of them could be a buyer because they could say, well, look, we're already building our stuff here. Why not double our production? You know, and especially if it's a midstream, the midstream guys, they actually have the money to do it.
Yeah, and also, you know, people that are in the Haynesville, right? That could see, they're like, well, we already have a Haynesville production. Let's couple it with the Haynesville production from these guys, and you know, double up.
All right, so take a look at this. So you have three things. You have Driftwood LNG, which is the one we're taking a look at right now, which is in Calcasieu Parish. But then you've got Cameroon LNG, which is supported by Sempra. I don't know if Sempra still exists right now or they changed their name or something like that. But you also have Lake Charles, which is LNG, which is owned by ET, which is Energy Transfer Partners. And then you've got the other ones that are here, which is Venture Global. Theirs actually is the most almost done completely. So basically, there are other players in the area that are already further along the process. The one that actually is Lake Charles is the one that natural gas. Let me just see. This is the one. This is how far along the construction they are. God damn it. I'm trying to find some good pictures of the actual terminal. But there are other LNG companies in the area that are there. And so the piping and the infrastructure and everything else is already around the area. So they could end up being like net buyers of the assets, because if there's got approvals already and they've got all the permitting done, that means that the only thing that's stopping them is just the capital that they need in order to finance the projects, which companies like ET have in droves right now. So let me see, Lake Charles gas facility.
It makes me think why a super major hasn't come in and tried to buy them up, and it might have been Kasuki's there, and that might be up for now because Haynesville there's a lot of production that goes on in Haynesville, and right now, I mean, natural gas prices are not bueno. So I mean, you have to think that it wouldn't be for today; it'd be for long down the road, but. Surprising that any major player, a lot of people are moving towards LNG. It's actually part of the reason why I own so much Shell is because they're a huge LNG player. And you could see in 2022, that's why they made so much money. But it makes me think a little bit. I mean, just for your awareness, Chris, I put up for 15.5 shares, hopefully that we could get it at the 967 price. But I put a limit at $10. I don't know what the price
I don't think it's gonna blow through the limit. You're gonna have to wait. Yeah, you're gonna have to wake up in the morning and just look at the pricing, because I'm telling you, Suki was the main thing holding everything back, dude. Damn. Everything. Okay. Anyone that I've spoken to about this, they said no, Suki is very like orthodox with his way of thinking. Like his thing is, so I think it's more Suki than anything else. And with him gone, I think that leaves a lot of room for Martin Houston, who's the vice chairman, to kind of come in and make some some deals that see the value of those bonds kind of skyrocket. So I would not buy the stock, because the stock is essentially kind of, in my opinion, worthless. But I think the bonds have a tremendous amount of value. And let me just take a look at their last quarterly report, because this way we can kind of assess what the valuation should be. 10K. SEC filings. Sorry. And by the way, did you see the filing itself on how they terminated him?
No, I didn't.
Oh, dude, they terminated him with like prejudice, dude. It wasn't even like a small thing. So here's what it is. Can you see that?
Let's see.
Okay. So right here, Tellurian. Okay, Tellurian issued press release announced that Martin Houston has been replaced as chairman of the board, pursuant to December 8th, 2023. The one that got me is this. right here may be required to pay. So the company provided notice of termination without cause as defined in Suki's employment contract and may be required to pay Suki certain severances. They always get these golden parachutes. In connection with the notice of termination, effective as of December 8th, Suki ceased to have apparent or actual authority to act for or on behalf of the company, including without limitation, apparent or actual authority to act as an officer, authorized representative, authorized spokesman for the company, and removed from all offices and directorships of the company. Can you fucking believe that? That's nuts.
So basically, you're
That is-
saying that he didn't have enough. He didn't have enough. I guess the word I'm thinking is
juice. He didn't have
Yeah.
enough juice. Oh
Yeah.
yeah, hell no, dude. He did not have enough juice at all, man. So, but here's their
zoom in on that
assets
bad
and-
boy if you can.
Okay, so
but yeah, I see what you're saying. Like he didn't have enough of like an umph. Like nobody really trusted his ability to execute or anything like that. So it was basically pushing a rope.
I mean, this dude's been selling shares all the way down, man. So whatever. But they've got about 59 to 60 billion in cash. They've got about 23 billion from receivables, probably from some of their upstream gas sales. So their current assets is about 96 million. Property and plant, they have about $1 billion. I don't necessarily trust this number. You know, I would probably cut maybe cut it in half.
Yeah, I was gonna say half.
Yeah,
I mean that's not like that land and access to the channel is not worthless.
Yeah. Oh no, it's definitely worth something. It's just not worth the shit that they're saying. Like, hey,
Yeah, billion.
it's worth $1 billion. No, I don't think so, dude.
$1 billion if you had the permit, right? like you know what I mean?
Well, if you had the FID, then it's worth way more than $1 billion.
Yeah,
But
yeah.
without that FID, you're basically just saying shit. You're not really, they had a good year last year because LNG prices were higher. So they do have, those upstream assets that they do have are worth something as well because they are cash flowing, but it may not be a lot. So you see here, their natural gas sales are about 43 million. They didn't have any LNG sales at the time because of course they're not producing anything, but essentially their operating expenses were 20, depreciation. This is non-cash expense, administratively. So they didn't really make too much money to begin with, but I wonder what part of this was doing the construction and all the other stuff that they have. So if someone could buy up those upstream assets as well. And I don't know how much those would actually fetch for with current natural gas prices being the way they are. But, there's an opportunity here because they do have assets. Like I said, these assets could be worth something. And so now you have to look at the borrowing. And what surprised me was they don't exactly have that much borrowing. You see their liabilities here?
Mm-hmm.
They don't have that many. Can you believe that? In terms of
It
borrowing,
makes sense. I mean, they have the land. They don't really have anything else, right? I mean, they don't have an obligation to pay Bechtel much until they have FID. So,
yeah. So you can see here that these are the long-term borrowings. It's not really, not that much. So let me just look at those.
So in terms of liquidation value, I mean, shit, I wonder what somebody could pay for this or restructure it, right? Or like acquire it and like keep all the management in place or part of it in place. And they tried to get this thing sanctioned.
So this is the thing that we have to be very cautious of, Matt. So you see this right here, how much of the principal is outstanding, right? So if you look here, September 2023, you've got senior convertible notes that are due 2025. These probably get priority, right?
Mm-hmm.
And then on top of it, you've got senior secured notes. These guys get priority over these unsecured notes of 2028. So the ones that we just looked at were this right here. So you can see here their total borrowings are about 391 million. So like I said, you're ahead of these guys, because if you look at how debt structures work, these guys, I have to just double check, but damn it.
That doesn't mean necessarily that like they have to pay it all back, right? They can issue another bond that's doable in 2030, and that could get everything and hold the company over, and then they just have to sit. It's so
like my thing is these are the lease obligations which come, I think, secondary to debt, but I have to double check on that because it's a lot of legal mumbo jumbo they have to deal with. But I think more importantly is this change of control provision that most of these bonds come with, because that's what I'm looking forward to. If these assets are somewhat valuable, someone wanting to say, let's take over the project, bring them under us because we're getting it at rock solid, cheap prices, like literally next to nothing.
Mm-hmm.
Dude, I'll pay off the damn bondholders a few hundred million and take over the entire project, which is already FERC approved. And all I have to do now is just reach out to some super majors and tell them like, hey, I have a project ready to go. What do you call it? Picks and shovels in the ground already. All I need is the money to complete the project and I'm good. So like I said, that's where the
15
opportunity.
billion, 20 billion, is that what you'll need?
Well,
how big was that? How big was Driftwood supposed to be? I mean, because Rio Grande is supposed to be like 20 some $billion to get it in the ground. By the way, shout out to the 120 some folks. I saw we climbed up to 145. Appreciate that on a Sunday night. Appreciate you guys sharing your Sunday night with us. Make sure you subscribe. We'll talk more during the week.
Well, according to them, it was actually supposed to be pretty damn big. Let me see. I'm trying to look at that data. Come on. Man, there's all this other nonsense here. You know what? I'm not gonna assume how much that they have. Well, actually, right here, 2 plants. Got it. Found it. So they were gonna have this right here. This was the total development cost, according to them, by the way, not according to the real numbers, because you never want to take management for what they're actually saying. It could be higher, it could be lower, most likely higher. But the total capacity was going to be 11 metric tons. So basically right here, this is the terminal. It would actually cost about $9 billion. The owner's cost would be $2 billion. The pipeline going into it is about almost $1 billion. Capital cost, financing interest. So basically, the total development cost of this thing would be about $14.5 billion for 2 plants, which is not that bad. Not that bad, But once again, it all depends on if any super majors want to sign up and take on this thing. But yeah. And this is the structure that they wanted to do, which is $7 billion in bank debt, 2 in mezzanine, and all this other mumbo jumbo, which at this point doesn't make any. All this is gobbledygook. I wouldn't even pay attention to this. Like I said, the point is the baby bonds could be bought out relatively soon if someone ends up taking this company out. So like I said, it's a gutsy move by us. The $200 could go Wusa as well. So don't think that that's not a possibility, but it's a learning experience and it only costs us $200. And if it works out, we get some good return from it.
Right? Yeah. I guess my question is what would our maximum limit price be for this? I mean,
I say, fuck it though. Watch what happens on Monday. All right. I think whatever the price comes up on Monday morning, fuck it. Just buy. Don't even think about it. Overpay.
What if it opens up at like 15? I mean, that's not going to be.
Oh, no. If it opens at 15, don't fucking buy it.
Well, you said just whatever happens, just buy.
That's a good point. That's a good point. Don't do that. I would say wait until Monday. Once it opens up, whatever the price is, take a second look. Maybe if it's under 12, definitely buy it, because that means that we're getting double the money. So I don't mind risking a little.
That's what I was thinking. I was thinking kind of 12.50.
Don't set any limits. Don't set any limits.
Because then somebody could be an asshole and just do a market sell, and next thing you know, we're paying 12.50 and it drops back down to $9.
So don't do that. The liquidity on this is probably shitty as hell too. So there's probably not. It could move very quickly on the upside. I mean, bro, I wish I knew about this on Friday. Like Steven's the one that called me. He's like, "Hey man, you heard that Suki's out at Tellurian?" I was like, get the fuck out of here. There's no way.
I had no idea.
So with him out the way, I think there's a possibility that, this could end up. So we'll see.
Well,
what do you think about this whole thing?
What, Tellurian or just in general, the stock?
No, Tellurian. Yeah, Tellurian. Yeah.
I think, to me, I don't understand why a super major hasn't come and tried picking it up yet. I think it's
I
too
bet you,
far
Matt,
east.
I can tell you exactly why. I bet you that they've had people reach out and say, hey, we want to either buy you out
Or partner.
and partner. More likely to buy you out. And Suki, who's on the board, probably said no. So now the board members have to get together and they have to say, well, what are we going to do? Are we going to do this deal or are we going to get rid of Suki? So now the deal at this point relies on, this asshole being cut out the middle. So I think the board has already been approached. And do you know how I know the board has likely been approached already? Watch this. This is going to shock you. And this is the part
because the thing that is just, I know so many people that produce in the Haynesville that it's just like they would love an ability to sell their Haynesville production at an additional $5 to $10. Look
at this right here. Are you seeing this?
Yeah.
You see this right here? This is Sharif Suki, who's the CEO. He's been selling all the way. But guess what one of the directors has been doing? He's been buying. And not a small amount, 100,000 shares, 100,000. So I'm like asking myself, I'm like, wait a second. What does one of these directors know that I don't know? And why would he be buying if the company was really about to go bankrupt and be completely out of the game? Why is an independent director buying shares right now? The guy's bought about 600,000 shares, So I'm thinking this has been approached.
I would check all the directors though, and is every director, or is this guy just ballsy? But
this guy's this guy's an independent director. There's a big difference between the other guys and him. The other guys probably owned also. Mm-hmm. So my thing is because the way the directors work is that you have your executives that are directors within the board, but then you also have independent directors that don't get paid by the company. They're just, they get paid by the company to be a director, but they're not necessarily like tied.
They're not the CFO. They're not the CEO.
Yeah. Right. So my thinking is they have a little bit more latitude. And so when I saw that buy, I was like, wait a second, what the hell is going on here? So I don't know. I got to look at some institutions if they're buying. We won't know until the fucking 13F. But I will say this smells very similar to what happened with Suki at LNG.
Mm-hmm.
You remember when Carl Icahn came in, bought up a shit ton of the stock, and guess what he did? He fucking ousted Suki. So my thinking is an activist probably came in, said, listen, I can get rid of this guy. I can convince the board of directors to join me. And once this guy is out, I can work with whoever's left.
To be honest, it could be, I don't know how much LNG Berkshire has, but Berkshire Hathaway Energy is pretty big. And I wouldn't put it past Warren. By
the way, I just want to clarify to everyone that's watching: do not follow us into this trade if you don't know what you're doing. This is a very high risk.
It's a gamble.
High reward. It's a gamble. This is me and Matt in Vegas right now, putting our money in black versus red, with better odds, I think, than that, because there's actually some due diligence and some research behind it. Yeah. And there's a marginal amount of safety because it's a bond and not a equity, which equity can get wiped out. Bonds, at least there's a chance that you get some of your money back, and especially if it's at such a big discount. So my thing is, I would not mind losing this 200. Just me and Matt right now, we've got a little bit of spare cash. If anything, this builds on our position. I independently do not own any Tellurian or Tellurian Z bonds. And you may actually see me buy some on Monday. But
I've started, I'll disclaimer, right? I have bought a little bit of NEXT because I feel like it's a little safer than a Tellurian.
It's much safer.
But you're also starting at...
Yeah. Sorry, Matt, you get cut off.
Well, sorry, you're starting at 40% of the price with Tellurian than you are with NEXT. NEXT is up about $1 billion. Tellurian, and granted, NEXT, it's a 17 MTPA, project. Tellurian, I think, owns 100% of it. So, you have to think of the ownership percentages. There's a lot to play in. It's 11 MTPA, but they own 100% of it. You got to pick and choose your battles.
Some people are like gambling chronicles.
Yeah, I like that.
Listen, all investing is gambling, except it's educated gambling versus gambling on the next meme stock. If you were to ask me, this is probably better than a meme stock, but but like I said, I know what I'm prepared to risk. You should know what you're prepared to risk. Because like I said, if this thing goes up, you make money. If it goes bankrupt and the equity gets wiped, I mean, the equity is definitely going to get wiped out if it goes bankrupt, and the bonds may not get the full value. So just letting y'all know, woosah, woosah.
We'll end, I guess, with the personal portfolio thing, and I'll kick you out of here because I know it's getting late, and I don't want Boss Lady to yell at you or me. But these are the recent trades. Chris, what did we get rid of?
We got rid of TLT.
Why?
Because I think Powell is going to come in and he's going to bring the hammer of Donkey Kong on the market this week. I think he's going to be very, very hawkish because everyone right now is like, oh, we're definitely going to get a March cut. March cut is factored in. Everything is great. And so I'm asking myself, hey, when was the last time this happened? It was like July. So the market got a little ahead of itself because all the numbers are pointing to happy times.
And the hand of fury came in.
And then the hand of fury comes in and just smacks the shit out of everyone. And then you see like the bond prices just skyrocket. So right now, if you look at the 10-year was up about 10 cents, 10 basis points just on Friday. And I think this week, the numbers are all healthy. Bitcoin is rallying. The stock market is on an all-time high. So basically every reason that you could possibly have for Powell to come in with the hammer is there. So I figured the best thing to do is just take some money off the top with TLT. We were up 10% on the position and, redeploy it some other places that have some better potential,
Yeah. So the recently added, we talked about BPYPM, Brookfield Property, preferred shares last week.
That's going to be the entire own episode, man. So that's a lot of ED. Yeah.
We need to do a little bit more. Yeah, I'd rather wait a couple quarters, but you never know with these things. Sometimes, like Chris said, oil could bottom out at 70 and it could do a quick turnaround back up to the $80. The thing that I like about $70 a barrel, though, is I think it's good for both. I think it's good for both the consumer. I think it's good for the producer. You're not making too much money where everyone's like, oh, these oil and gas companies are making hand over fist, but at the same time, you're not paying too much at the pump. I think $70 to $80 is a perfect medium right now. Once it gets above 80, I think it's just too much for everybody. But I think Oxy, it could be a good buy here. They also pay a decent dividend, and they're getting in better shape as well. So can't complain with that one. We still have Verizon. We also bought two companies that people have also, I guess, three other companies: Extreme Networks, HashiCorp, and Next Decade. Next Decade's a very small position, not even a whole share. 0.25 of a share, so a quarter of a share, which we'll continue to add to with any dividends that we get throughout the portfolio. But do you want to talk a little bit about HCP or Extreme? Just a little teaser, and maybe we could talk about that on Tuesday or Wednesday.
Okay. Yeah, Extreme Networks is a network switching company where basically they make switches and access points for enterprise grade clients. There's a lot to unpack here. So they were recently sold off because of some small near-term weaker guidance. And so they got sold off pretty bad. And then HashiCorp was kind of the same thing where they got sold off based on some not such great guidance, but they do have a good cash position. They're a very small cap company. I think that these guys could meaningfully recover in the next few months, which means that we could possibly eke out some returns from there, but they've both been sold off. And I think those are the only two. And then Brookfield Property. I think a lot of people don't necessarily understand how the commercial real estate market works, but there's actually a good amount of opportunity here, especially in the preferred side. And like I said, that's something that I'll probably go over in a bit more detail in the future.
Yeah. Well, apologies. I know people are messaging that they can't see. You can either try to zoom in on your mouse pad. You can try to zoom in on your screen. Snipping tool, which maybe next time I'll have to save this as a PDF or something to be able to zoom in. But the snipping tool doesn't allow you to zoom in, unfortunately. So this is
P.S. None of this is financial advice. All right. All of this investing is all at your own discretion.
Yeah.
None of these companies are, hey, Chris or Matt told me about this is what we think. And we've set up a portfolio ourselves to say, hey, listen, can we beat the market? Can we overperform, underperform the market? We may not be able to do that, so definitely don't rely on us to give you that information. If you guys want, it's a great way to just at least explore some companies and ideas that you may not be familiar with and explore those concepts. And that's it. It's not financial advice.
No, I think the thing that we use this more so is as not educational, but I guess it's more of an idea is to see different perspectives. I think the majority of people should listen to the likes of Warren Buffett, invest in the S&P 500, and really just sit their money and park it. Unless you're able to do a lot of the due diligence that Chris has done or that I have kind of done, which, I've done a little bit on Bros, I've done some on Orsted, I've done some on Rocket Lab, and TQQQ is my gamble piece. But, unless you've done a lot of the due diligence on some of those things, it's hard to be able to walk away and say, yep, okay, I feel good and confident investing in these things. And to be honest, I mean, with what we talk about here, we just give the highlights of what we've kind of done as due diligence, right? We don't go through exactly everything that we do to be able to meet our investing criteria and thresholds. So if that's the case, then you guys might be missing out and miss something. And of course, as always, I talked about this a little bit on my stream yesterday, my little one-on-one stream with everybody getting down and personal, but it's personal finance for a reason, right? Like Chris and I invest in these companies like, for example, this is play money for us. This is the money we get based off of what we do off of YouTube, right? Like a lot of these things could be huge gambles that we don't even invest in our own portfolios. So that's something to kind of take away. And also second is, we're both probably, I don't know, I can't speak for Chris, but, I could say this, sitting on a 7-figure portfolio, it's okay if I lose $50 in Upsellera, like I'm not going to be sitting under a bridge with a cup hoping people come by and give me a little bit of money, so these are completely secluded from our normal portfolios. I don't have, aside from Dutch Bros, Orsted, and Rocket Lab and TQQQ, I don't have any of these other opportunities in my portfolio. I guess Upsellera as well now and NEXT, but some of these are us to learn ourselves as well and dive deeper into some theories. And what these might be is just taste testers and teasers for what we might put onto our own portfolio. And as you've seen, we exit and enter positions very quickly. We entered TLT. We thought it was a good opportunity to enter TLT, but I'm with Chris. I think if you're not a long-term investor and you're trying to be more nimble, I think that the hand of God is going to come in and smack people this week because everyone's been talking and the market's been running as if we are going to see rate cuts in March timeframe. And I just think it's too premature. I think we still have some time to go. And so that case, $91 range here in the next couple of weeks, and it might be an opportunity to load up again. But if you're not paying attention, fortunately we see people come in pretty regularly, but sometimes we don't see people come in for weeks at a time. And if that's the amount of time, you're looking at your portfolio once every couple of weeks or so, and you're trying to be as nimble as what we're trying to do in this portfolio here, you might miss something, like unless you really are holding something like this for the long term, there's going to be a point, for example, when the play of Verizon is done, right? And Chris probably won't want to play with it anymore. And that's because, you've been able to see the gains. It goes back up to $45-$50. And Chris is like, okay, we're done. We're on to the next thing. We're taking that money and putting it elsewhere because we played out the theory. We tested out the thesis and it worked. And so you kind of have to recognize it's not like something where you can just sit and forget, right? These EXTR and HCPs, I think this is something that's going to be very quick as well. Chris kind of said, they've been battered down pretty hard over the past few weeks, and we'll talk about it in another episode. But, this is something we might hold for a couple of weeks and then boom, it's done and dusted, and we might not see it again. So Just some food
Yeah.
for thought that, just because you see it here today doesn't mean it's going to be here next week.
Yep. One last thing before we go. Tellurian's that tells Z bonds, they actually have an X date coming up next month in
Do they
about
really?
2 weeks. So we'll get our first payment in 2 weeks.
Hell
So
yeah.
I'll take it. De-risk, baby. I'll take all the de-risk.
We'll de-risk. We'll put it into NEXT.
Yeah, exactly. Use one guy to basically pay for the other one.
Yeah,
That's what
cool.
you do. That's how you gamble, baby. Put it on black. If it comes up, take it, spread it around a little bit. Let's see. Dude, I'll be so happy if this works out the way it does, because this will be a teaching moment where retail investors don't ever get into the bond market. And this will be an introduction into how bonds work. Because this is the easiest way to get into the bond market, where you have a security that's trading with underlying representation from bonds, which doesn't happen. So,
yeah, and I want to I don't want to end on this necessarily, but yes, I do have NextEra Energy, not the partnership. I like NextEra as a whole. I think Florida Light and Power is a really good company, and I think they've done that.
The quarterly dividend is 51 cents. Just let you know.
For TellZ?
Yeah, it's 51
cents.
Cents. Hell yeah!
We buy 15. We're gonna get, what is that? 15 times
$7, bro. $7.50.
I'm not good at math. $7.50. Okay.
Yeah, we get $7.50 a quarter. It's not bad. I'll take that. Pays for the StreamYard account. But
yeah, let's just see. That ends up being $7.50 times 4, $30. Which, yeah, it pays for 3%. 3% yield of the entire portfolio. That's pretty good.
Yeah. Let's do it. Let's see it.
Yeah, I'll be sure to do it. I'm hoping. I have it set for a $10 limit. But
look at these guys in the chat, man. Everyone's like, who here is buying TellZ this week? Man, you degenerate gamblers. Don't goddamn buy it just because we said so.
So I would say NextEra, I think it's an okay price here. A month or two ago, it was a great price. And it got hit because of basically the NextEra partnership got hit. And they said that they're no longer going to use debt to expand and yada, yada, yada. So they got hit pretty hard. But be sure, for you guys that are new, we had 150 odd people in here at one point. Be sure to subscribe. This is not the Finance Junkies channel, although we have Finance Junkies all over the thumbnail. We loved having you guys here on a Sunday night. We look forward to seeing you again on Tuesday through Thursday. Hey, this is a little teaser for you guys. We get enough viewership up, we could be here every day. I don't know, Chris. I know that I've talked about it. I'd love to do it every day. You might be too busy with having 2 streams that you're on pretty much 24/7. But
just breaking news: Bitcoin's crashing.
Bitcoin is crashing, but it is. Let's
there's I guess like some news just came out from the SEC.
Oh,
Bitcoin.
Really?
It's a flash crash. Yeah.
Like crash? Hold on. Breaking news. Let's extend this a little. It's
a flash crash. Let's. I'll bring it up on Twitter. 1 second. So
my portfolio is. I just have a small little Robinhood portfolio that has like 0.1 Bitcoin in it.
Right.
Oh, there you go. It's coming back. Yeah. I saw it ping up on my phone that it was below 42, but it looks like it's coming back.
Hold on. What the hell happened?
I don't know what you're looking up, Chris. All this, you're seeing the Arabic.
It's because I was trying to donate to Hamas using some Bitcoin the other day. I want to test the theory and see if they would accept it. Apparently, it's a thing. By the way, I did not donate any money to Hamas using Bitcoin. All right. I don't use Bitcoin. I don't donate to freaking terrorist groups. But what the hell? All right. Well, I'm trying to look for some news. Usually there's.
Oh, you were looking for news. I was just trying to pull up the price. But yeah, let's just take.
Let's see. BTC. Right here, crazy deal. Stop using margin to buy. There's Bitcoin massive dump happening. This is an hour ago, but it's already recovering.
Yeah.
See, this is what I love about Twitter, dude. This is what I love about Twitter. Twitter is like it's like the zeitgeist of the world. So you literally get so much. Then you have all the people coming out present to you bear trap, Democrat, Republican, fix the money, fix the world, and then you're always gonna have your Bitcoin people.
I think it's funny, man, because like people, a stock market will open up and they're like, "What's going on with Palantir today? It's down 2%. The market's crashing," and you're like, "The market is also down 2%." Like, you know, people just sometimes they just have such tunnel vision that they're like, "Oh my God, the $20 that I'm down on Palantir is going to be the end of me," you know, like, and, you know, I'm not trying to be a dick, but it's the truth sometimes.
Damn,
it's
that's
like,
a fast recovery. It's already recovered like pretty quick. It went from 41,700 to
that's about
almost
42.
like 42.
Yeah. 5.
That's a very short period of time.
Yeah, it's flash crash might be right, but that's typical of Bitcoin. It'll like drop 5% and then come back 5% within a matter of a couple hours.
What's the reason? All right, I'm looking at Bloomberg right now. Bloomberg says, "Damn it, I don't have. I gotta subscribe to. I gotta upgrade my subscription."
But that's the part of the reason why I think Bitcoin has been up so much is the SEC approval for a lot of these spot ETFs. So I think you have the BlackRocks and Vanguards of the world starting to actually take ownership in Bitcoin. And so with that, I think that's what the price is driving up to 44. I don't think this is based off of a lot of hype like what we see in 2020, 2021, where the price went up to 60 something thousand. I still think this is has a long way to go.
All right, well, whatever, man. If you want to invest in magic money, that's fine. I'll be buying distressed oil bonds. That's what I want to do.
Hey, man, I'll be doing both.
I'm old school investor.
Hey, I look at it. I look at it like this. I look at it like I have close to a Bitcoin, which isn't a lot, but it's also more than most people have. If it goes to like 200 grand or 300 grand, I'm probably selling it, and I'm probably buying a bunch of real estate with it, and I'm probably calling it a day. Right?
Yeah.
My sister keeps bugging me. She's like, "Man, it'd be nice to have something in the Outer Banks." And I'm like, "I know, I get it. Like, I know you want me to be richer, but I'm not there yet. Like, I'm getting there. I'm trying. I also would love to have something in the Outer Banks, but yeah, we'll get there. I have something in Dirty Jersey, and I'll get something in the Outer Banks eventually."
All right. Well, can anyone explain in there what was the cause of the flash crash? If anyone knows on here, post it in the chat because I'd like to know. Just for the hell of it.
No, what? Sorry, it cut out for me.
No, the crash. The flash crash.
Why.
What happened?
No idea.
BTC epitomizes the bigger fool theory. Absolutely. Absolutely.
Cool.
All right. Well, I will see you guys later. Have a good one.
Let me know if Junkies cancel tomorrow as well, and we'll be more than happy to jump on maybe an hour or do a 2-hour special.
Yeah, sounds good, man.
All right, my friend. Good chatting with you. Cheers.
Take care. Bye.
Bye, everyone.